This isn't a bull market anymore, it's a currency failure playing out in real time. Gold isn't rising because investors are optimistic. Silver isn't exploding because of speculation. They're moving vertically because confidence in paper money is breaking fast. And once that psychological line snaps, it doesn't reset gently. Look at the numbers. Gold above $4,700 an ounce, silver pushing past 90. That's not a normal repricing. That's the market abandoning yield and running for shelter. Not tomorrow. Now, and this isn't about traders getting rich. It's about a system hitting a debt wall it can't refinance without destroying itself. Trillions coming due, rates that can't go down, buyers that are backing away. The math is closing in. If you're holding cash, this matters immediately, because when real assets double, it's not that they're gaining value, it's that the currency measuring them is losing it rapidly. On the surface, markets still look functional. Prices still print. Exchanges still open. Officials still speak calmly. But underneath, trust is evaporating. And once trust goes, the reset doesn't wait for permission. What's pushing this forward isn't enthusiasm, it's stress moving through the system. The trigger sits in the global bond market, and the loudest warning light is flashing in Japan. For decades, Japan exported capital to the world, keeping global borrowing costs low. That flow acted like a stabilizer. But now domestic bond yields inside Japan are surging to record levels, forcing capital to come home. Money that once propped up foreign debt is being pulled back fast. That shift lands directly on the United States at the worst possible moment. Trillions in debt need to be refinanced just as one of the largest buyers steps away. And when demand weakens, yields don't fall, they rise. That's why rate cuts no longer work the way people expect. The market isn't reacting to policy, it's reacting to solvency risk. This is where the framing breaks. This isn't about the Federal Reserve choosing to be loose or tight. It's about the bond market questioning whether the math still works. And once that question enters the room, liquidity becomes defensive. Here's the reframing that changes everything. What happens when the world's safest asset starts behaving like a liability? Because when that perception spreads, the move out of paper accelerates. The escalation doesn't stop at bonds. It spills straight into geopolitics. What used to be a coordinated global system is breaking into competing blocks. Trade is no longer about efficiency. It's about leverage. Tariffs are replacing treaties. Access is replacing trust. And the dollar's role at the center of that system is no longer being protected. It's being used. The United States is signaling a shift away from defending a strong dollar toward prioritizing domestic advantage. That means reciprocal tariffs, barriers on European goods, and a deliberate willingness to make access to the U.S. market more expensive for everyone else. This isn't theory. Specific tariff levels are being discussed, and countermeasures are already forming abroad. Now notice what that implies. A strong dollar once benefited foreign central banks and global trade partners. A weaker dollar shifts the burden outward. And when the anchor currency starts behaving like a policy weapon, alignment collapses. This is where the story flips. Central banks stop acting in sync. Independence erodes. Monetary policy starts merging with fiscal objectives. The Federal Reserve isn't just watching inflation anymore, it's being pulled into national strategy, and once globalization fractures, capital doesn't wait around to see how bad it gets. It moves first. From there, the response shifts from markets to territory. When supply chains stop being reliable, access to raw materials becomes a security issue, not a business one. And that's exactly how governments are starting to behave, not as regulators of markets, but as direct participants racing to lock down physical resources. You can see it in the urgency. Strategic interest in places like Greenland resurfaces. Executive actions open vast mineral regions in Alaska. Projects that sat dormant for years suddenly get fast-tracked. Gold, silver, copper are no longer framed as commodities, they're framed as necessities. This is where normalization breaks. Governments don't invest hundreds of billions directly into mining unless they believe the open market can't deliver what's needed in time. That move alone tells you confidence in global supply has cracked. And notice what's being designated as critical: silver, copper, inputs for energy systems, electronics, and defense. Once a material gets that label, it stops behaving like a free market asset. It becomes strategic, controlled, prioritized. This is a quiet escalation most people miss. Trade disputes evolve into resource competition. Competition turns into stockpiling, and stockpiling drains the market faster than prices can signal scarcity. Because once states start hoarding, availability matters more than cost. And that's when the supply problem stops being theoretical. The next pressure point sits inside the supply itself, and this is where price stops being the solution. Silver doesn't respond to higher prices the way people assume. Roughly 3/4 of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means supply isn't elastic. You can double the price and output barely moves. The metal isn't being mined for its own sake. It's coming along for the ride. At the same time, the pipeline is already strained. Ore grades are declining, new discoveries are rare. Projects that were shut down years ago can't be restarted quickly. Bringing a mine online takes close to a decade. There is no surge capacity waiting in the wings. Now stack that against what's happening on the demand side: green energy, electric vehicles, grid expansion, defense systems. Consumption keeps rising, but unlike gold, industrial silver is used and discarded. Once it's gone, it doesn't come back to market. This creates a permanent imbalance. Prices rise, but supply doesn't catch up. That's the line people miss. This isn't a cycle that self-corrects. It locks in, and once a market realizes there's no mechanism to flood it with new material, behavior changes, buyers stop waiting. They secure what they can while they still can. The pressure finally breaks where the system is weakest. On paper, the silver market still looks liquid. Contracts trade, prices update, everything appears orderly. But behind the screens, something unprecedented is happening. Large players are no longer rolling contracts or settling in cash. They're demanding delivery, physical metal. Now, that shift alone changes the game. In a single month, tens of millions of ounces move out of exchange vaults, volumes not seen in decades. The structure these markets rely on assumes most participants never ask for metal. When that assumption fails, the leverage is exposed, and the stress shows up fast. Settlement delays stretch from days into weeks. Inventory drains. Exchanges respond by raising margin requirements, not to cool speculation, but to force weaker players out. It's defensive, it's about survival. This is where confidence wobbles, because once participants start questioning whether the metal is actually there, paper claims lose their power. The price on a screen matters less than the ability to take possession, and when enough people reach that conclusion at the same time, the system faces a choice it was never designed to handle. What happens if demands for delivery keep accelerating? The shift doesn't stop at exchanges, it moves across borders. The center of gravity for pricing is pulling away from the West and snapping toward the East. China and India aren't treating silver as a speculative asset anymore. They're treating it as a strategic input. Exports are restricted. Domestic supply is retained. Banking systems begin integrating silver into collateral frameworks instead of relying on Western benchmarks. This is where valuation quietly breaks. Physical silver in Asian markets trades at a growing premium to US spot prices. Not because of hype, but because delivery matters more than paper claims. Two prices emerge for the same metal. One for contracts, one for possession. And here's the detail that changes how you see the entire market. When a major central bank begins valuing silver alongside gold for collateral purposes, it stops being an industrial commodity. It starts behaving like money again. That single shift reframes demand permanently. Now notice what can't happen anymore. Arbitrage. In a functioning global market, price gaps close fast. But export controls, approvals, and physical bottlenecks prevent metal from moving freely. The gap persists. That tells you something fundamental has broken. The global price is no longer unified. It's regional, physical, political, and once pricing fragments like that, the old reference points lose authority, which raises the next question. What happens when strategic demand meets military necessity? At that point, silver stops being just an economic input and becomes a security asset. Governments don't label materials critical unless failure to secure them threatens national defense. That label now applies to silver, not because of jewelry or investment demand, but because modern weapon systems depend on it. Advanced electronics, guidance systems, missiles. The quantities involved aren't symbolic, they're massive, and they're non-negotiable. Once a metal enters that category, normal market behavior ends. Demand becomes price inelastic. Military procurement doesn't wait for pullbacks. It buys what it needs when it needs it. And those purchases don't always show up in public inventory data. Stockpiles grow quietly. Supply drains invisibly. This is the part most people miss. Even if prices surge, substitution isn't easy. Replacing silver with alternatives like copper or graphene isn't just expensive. It's slow, technically complex, and often inferior. For systems that can't fail, cost becomes irrelevant. So a floor forms under the market, not from traders, from governments that cannot afford shortages. And once that floor is in place, volatility shifts direction. Pullbacks get shallow, rallies accelerate, because when defense demand enters a market already running a deficit, scarcity stops being cyclical. It becomes structural, and that pushes the system toward its next breaking point. Behind the scenes, the discussion shifts from markets to planning. There's growing talk of using metal prices as a stabilizer, not a signal. Revaluing silver isn't framed as speculation, but as a way to absorb pressure inside the system. Higher prices inflate balance sheets, they offset debt, they create room where none existed, and unlike printing more currency, repricing a scarce asset feels controlled. That's why specific price levels start circulating, not as predictions, but as thresholds, levels where industrial demand still holds, where collateral frameworks still function, where the system can breathe. The idea isn't to make silver expensive, it's to make it useful again as an anchor. At the same time, monetary roles blur, central banks move closer to treasuries, independence gives way to coordination, inflation is tolerated, asset prices are allowed to rise, stability is redefined as avoiding collapse, not restoring the past. This is where timelines matter. Policy shifts don't announce themselves early. They surface around events, tariffs, resets, deadlines that force decisions. By the time the move is visible, it's already underway. And once a single nation formalizes a new role for silver, others won't wait. They'll follow. Because in a fragmented system, no one wants to be last holding claims instead of assets. What matters now isn't the exact price of gold or silver, it's what those prices are revealing. They're exposing a system that no longer trusts paper promises to hold under stress. A system that's quietly shifting away from claims, contracts, and assumptions toward things that exist without permission. That's what a reset actually looks like. Not an announcement, a migration. When physical assets reprice this fast, it's not about upside. It's about repricing risk that was hidden for years. And once that risk becomes visible, it doesn't get priced back down. It gets redistributed. Most people will notice only after the gap is too wide to cross easily. When spreads stay wide, when delivery matters more than quotes, when access matters more than price. By then, the narrative will sound obvious in hindsight. The question is whether you're watching the signals now or waiting for confirmation that only comes after the move. If you want to keep tracking how this reset unfolds and where the next pressure point is forming, follow for continued analysis.